Hey, everybody, welcome to tonight's program. Let me know if you can hear me okay. Had a little bit of audio trouble, so if you can let me know in the chat. And okay, can everybody hear me okay? Can you hear me okay? All right, what time does the 7 p.m. program start? Okay, I had a little bit of trouble with my audio, so hopefully you can hear me. So let me know in the chat if you can hear me. Um, MH08 is in the house. What's so shocking? Where's the fire? Okay. All right. Terrific. Everybody can hear me. Okay. Excellent. All right. Well, tonight, sorry about the little bit of a late start here. So I apologize for that. But we're going to go over an article from Housing Wire about the 2026 housing market and how you can look at some of the early numbers in December to kind of give you a clue as to what's going on in the 2026 housing market. But there's a lot of news out there. A lot of everybody does their prediction, and I do that as well. In fact, I asked the audience for their prediction as to what they thought the uh, market was going to do, and we'll tap into that. And I'll share my screen. I asked, what do you think U.S. home prices will do in the next 12 months? So 48% said they would go up, 23% said they'd go down, 23% said they'd stay about the same, and 8%, so that's about four people, thought it would, or three to four people thought it would crash. So that's interesting. So we're all over the map on that. And all right. So and Bud says, "Hey, I can hear." Okay, terrific. Okay. And hey, son of Joxer's in the house. All right, terrific. Great to see you. All right. So if you hadn't had a chance, and I think let's see, I did a poll. I also have a poll in the live stream. So if you want to put your input on that, but we're going to go over this article from Housing Wire. Okay, and let me share that with you, where it says uh, December housing data provides early signals for the 2026 market. Okay, and this is again written by Logan Motoshami. So Logan's kind of fun to listen to. He has a podcast, and if you like to nerd out on all these numbers and that sort of thing, he's fun to listen to. And he gets in fights with people on Twitter over, because there's a lot of folks out there they're not housing analysts. They just like to chime in and say some crazy things, which they have a right to do that, but he likes to take them on and that sort of thing. So it's um, all right. And so MH08 said votes in the poll. I didn't get the chance to take it. Okay, let me see here. I'm not sure if it should be in the on my post on the when you go to my channel, it'll be under posts. I'll share this with you here. Um, when you go to the channel, it'll be under posts, and then you can take that poll. Okay, where do you think home prices will be in the next 12 months? So that's where that's at. And then again, if you want to check out my prediction video, my prediction video is Omaha's 22 right here. I just put it out today, so I can throw a link to that in the chat. Let's see here. Maybe not. Share. Okay, I'll put that in the chat, and then you can watch it after the program if you'd like. All right. So there we go. All right, we'll go back to this article. Again, it's written by Logan Motoshami, and he says, I won't read the article to you. I try. Maybe it won't let me share that. Okay. All right. We'll jump back here. Okay. It says December is normally the weakest month in the housing demand, and that's true. Um, And then what's kind of funny is you'll have, because there's a holiday in there, so whenever you take and put a holiday, hey, we got James in the house. All right, James, thanks for stopping by. All right, terrific. All right. And post-COVID, early season demand shows up sooner. November and December now carry real predictive power. And these late year numbers help forecast the strength of the spring 2026 market. Okay. And then he goes on in the article and talks about in 2022, we had a sales crash. Notice I said sales crash and not a price crash. Okay. And that's when rates went up so fast that it just killed off demand. Okay. And you can see that here where we were at 6 million sales. And this is all national numbers here. Okay. In 2022, we were above 6 million sales. And then sales dropped off significantly in 2022 to 4 million. So this is kind of like the base of 4 million. And we've ever since January of 95, we have sold have been 4 million sales of homes since 1995. Well, after that rate increase, well, then what happened? Those sales went down to that baseline of 4 million sales. Okay. And then what happened was in 2022, and I remember going into that fall, it was just like somebody turned off a spigot and, homes were sitting. And then all of a sudden, in March or in early spring of 2023, rates went down and then sales picked back up again. Okay. And I'll kind of show you that. And this is the 30-year fixed rate mortgage. Okay. Over the last 5 years. And this is what he's talking about. Oh, I got to remember, I almost need like a producer. But this is when in October of 2022, we had rates get up to that 7.29% range. And then what happened in the fall and in December, rates went back down again. And then what happened? Sales picked up again. Okay. That surge produced one of the largest monthly home sales jumps ever in February of 2023 with roughly 500,000 homes. Okay. The same setup is forming now with rates near 6%. So Logan is saying in his article that we're looking to have a very robust spring. Okay. And a couple key things to track. Okay. Mortgage rates in the 10-year Treasury. Okay. Now he does a forecast. Okay. In my 2025 forecast, I anticipated the following ranges. He said mortgage rates between 5.75 and 7.25. And he said the 10-year yield or the 10-year Treasury fluctuating between 3.8 and 4.7. So the 10-year Treasury and the 30-year fixed rate mortgage move in tandem. They move together. Okay. And then what he's saying is that mortgage rates and the 10-year Treasury. Great name for a band. Okay. All right. What he's predicting is softer labor data plus Fed rate cuts equals lower yields and lower mortgage rates. Okay, so if the 10-year, this is the 10-year Treasury yield, if that stays near 4%, then rates will remain near 6% heading into 2026. Okay, there's going to be a Fed meeting in December, and that's going to kind of be a wild card. Powell has been very hawkish, and if he's hawkish, then rates could push upward. So we don't know how that Fed meeting is going to turn out. But if he's a little bit more hawkish, then um, we could see rates move upward. And then the other thing, now when you have the 10-year Treasury and the 30-year fixed rate mortgage, they have a thing called a spread. Okay. And then he goes on to talk about that. Okay. And this has been really good news for the 2025 housing market. Okay. Because what this chart does, okay, this was the spread in 2023. Okay. So in November of 2023, there was a 2.87% difference between the 10-year Treasury and the 30-year fixed rate mortgage. Okay, then in 2024, it got a little bit lower. And what did that do to rates? Rates came back down. And then in 2025, it's even lower yet. Okay, so we're getting closer to being back to normal in terms of the spread. Okay. And let's see what MH08 says. A small hike in the Fed rate could smooth some inflation fears, lowering the 10-year yield to the 10-year. Exactly. Okay. So, because the Fed doesn't really care about the housing market, what they care about is jobs, and they have a dual mandate: jobs and inflation. So what they're trying to do is, if inflation peak, gets higher, then what they do is they hike the Fed rate in order to squash inflation. Okay. And you can see that if we go back and look at the 30-year, max this puppy out, way back in 1980. Okay. Way back in 1980, when interest rates were at the mortgage interest rate was at 18%. Well, what they did was they hiked the federal funds rate back then was like at 12%. So a guy by the name of Paul Volcker, who was the Fed chairman at the time, he jacked up the Fed funds rate in order to crush inflation, because in the 70s and early 80s we had really severe inflation. And what they did was that took care of inflation, but right there, it also killed the housing market back then. So if you talk to a lot of really, really old agents, they talk about how mortgage rates back then were at 18%. And there was a severe recession along with that. So, okay, and MH08 said Reagan even asked Volcker to lower rates, and Volcker held tight. Yeah, so exactly. So I was just a young lad at the time, but yeah. And then coming out of that recession in 1982, Reagan, we came out of inflation and we had a really robust economy coming out of the latter half of the next 6 years with Ronald Reagan during that time. So anyway, we'll go back to the article. All right. But anyway, the spread is getting better. So the spread is decreasing, which is keeping interest rates lower. Okay. And then he talks about in the article, if spreads were still at 2023 levels, today's mortgage rates would be 0.91%, almost a percentage point higher. So right now they're at 6.3. Okay. And if spreads were back in they would be almost a point higher. So you'd be looking closer to just over 7%. Okay. So we'll go back to the 5 years. Here's where mortgage interest rates are at now, at 6.3%. Okay. But the lowering of the spread is really good news. Now, if spreads were to fully normalize, okay, rates could drop to 5.63 to 5.83. So it'll be interesting to see in 2026 how the spread is. Okay, so if that spread continues to decrease, that's going to be good news for the housing market. Uh, have to look at the spreads as a percentage, not as a fixed number. Exactly. So this is 2.19% versus 2.85%. Exactly. All right. Excellent. And then the other thing that he's talked about here that's positive is a thing called mortgage purchase application data. Okay. Demand improves when rates fall below 6.64%. Since rates dropped in late July, we've had 10 positive weeks, 7 negative weeks, and 17 weeks of double-digit year-over-year growth in mortgage purchase applications. And that makes sense because this is an early indicator. If more people are applying for a mortgage, well, then that's going to translate to more sales. Okay, so we are seeing more mortgage purchase applications. Okay, and in the entire year, he points out that we had 22 for the full 2025 year to date. We had 22 positive readings, 18 negative readings, 6 where it was flat, and 43 straight weeks of positive year-over-year data, and 30 consecutive weeks of double-digit growth year-over-year. So more purchase applications, that's going to translate to more sales. Okay. The December gold sustained the positive week-to-week trend with rates near 6%. Okay. Now we're going to talk about housing inventory. Okay. Inventory is finally normalizing after the 2020, the COVID shortage. Okay. So for so long, we've talked about a shortage of inventory. Well, guess what? Okay. This line right here, this top line is 2019. Okay. That was pre-COVID. And this is nationally. Okay. Inventory is up 15.68 year over year. So here's 2025 in red, and this orange line is 2024. So we have more inventory. And as you can see, this year is starting to come close to that 2019 level. So that's a very positive thing because that would be pre-COVID. Look at 2021 when inventory, we're at right now we're at 817,000 homes on the market. Look back in 2021. In November, we had 374,000 homes, almost 375,000 homes on the market. So inventory is going up, which is good because we need more of a normalization. So this was all the COVID market down here, 21, 20, 22, and 23, 2024, and now 2025. So we're starting to normalize in terms of national single family inventory, which is good. Sellers have less power during the post-COVID frenzy. And although Denver, I'm thinking MH08, okay. Although December brings seasonal declines, the bigger picture is rising, healthier inventory levels, okay? And then he kind of concludes the article with, I tried to have notes this time around instead of reading the article. So hopefully it made more sense. I don't know. Bottom line, monitor two things during December, the 10-year yield and mortgage rates staying near 6%, and purchase applications continuing to rise weekly and annually. If both hold, early 2026 is positioned for growth. And forward look. This is all forward looking data, and it moves real quick. Ignore it, and you'll get blindsided, just like many who did in 2022. So that's today's article. Okay, and I wanted to bring up. I wanted to kind of do something kind of fun here, and I'll show you this here. Okay. Um, because last week, um, there was the article that was put out there that said that the price correction worse than 2008 is coming to the U.S. housing market. Okay, and that was put out by Melody Wright. Okay, she made that prediction that 2026 is going to be worse than 2008. Okay, Clark has something to say here. We have inventory down here, but some areas the inventory available is not the best resale wise. Some of the properties need work. Yep, exactly. And Clark, I'm sure you agree with this. In that COVID market, if it had four walls and a roof over it, hey, the thing would sell, and sellers could get by with just putting anything out there and it would sell. Well, the market has changed now, where now sellers don't have all that power. Now they have to actually do the things that sellers need to do in order to get their home sold. So, um, it's not, you put it on the market. We'd put something on the market, and lo and behold, you would get, 15 offers, and it would sell in a couple of hours. That market is done. Okay. But you're in a different market, and you guys are seeing a little bit of price declines, correct? Okay. MH08 gives that face. All right. And then Clark says, yep, the sellers are still trying to do that now in this market, and that's not going to work. And I don't, but for 4 years, sellers got by with that, but now it's not that case. So, but what I thought I would do is I thought we'd have a little bit of fun. Everybody has their opinion on the housing market. Who's to say? She could be right. Maybe the housing market would correct to 2008. I don't believe so. Okay. And so I thought it'd be kind of fun. And that is, I thought we would go to Chat GPT, okay, and ask Chat GPT, act as if you were an expert housing market analyst. What would it have to take in the economy for a 50% crash in home prices in 2026? Okay, now here's the deal. Chat GPT is AI, so who knows what it's going to say. But I thought it'd be fun to put that question in there to see what Chat GPT would have to say, what it would take for a 50% crash. Now, Logan in his article had, his kind of like, model of the market. Let's see what Chat GPT has to say. Let's see, more than willing to give credit for work that needs to be done on this dump. It's that or a tear down. Okay. And then MH08 says, ask Chat GPT what day it is. Okay, I will do that afterwards, but we'll run this scenario first. Okay. Again, act as if you're a housing market expert housing market analyst. What would it have to take place in the economy for a 50% crash in home prices in 2026? So let's see what Chat GPT says on that. Maybe it won't say anything. There we go. Okay. And let's read through this and see what you guys think if this sounds reasonable. Okay. All right. If you're talking about a true 50% national home price crash in 2026, understand one thing up front. It's economically possible, but the bar is extremely high. You need a stacked collapse across credit, employment, liquidity, and forced seller pressure that dwarfs 2008. Okay. Here's the straight, unsugar-coated version, the conditions must all align to get anywhere near a 50% national decline. Okay. And what the article says, well, it says, well, hey, the median sale price or the median household income can't purchase the median household, uh, the price of the median house. So they're saying how that has to realign in order for the market, so it has to crash though. Okay. Now it says a massive rapid spike in unemployment. You're looking at 8 to 12% unemployment. Okay. Right now we're at 4.6. All right. And MH08 says exactly massive job losses. Okay. Think multi-industry layoffs, not isolated sectors. Tech, manufacturing, logistics, government cuts, healthcare slowdown, broad-based job losses, unemployment climbing above 8%, heading towards 10 to 12%. Okay. Without forced selling, prices don't crash, period. That's according to ChatGPT. Okay. Mortgage rates stay high or move higher, and you're looking at 8 to 10%. To cut prices in half, you need affordability to implode even further. Now, it's tough to be affordability is a challenge. There's no doubt about it. Okay. Rates stuck at 7.5% to 9% or higher. Credit tightening from banks removes first-time home buyers. Okay. Mortgage availability drops like it did in 2008 and 2010. Okay. High rates plus job losses destroys demand. Okay. Now you got on top of that a credit freeze or a banking crisis. A national bank crash requires systemic credit failure, regional bank failures, major lenders pulling back on mortgage credit, private mortgage securitization freezing, investors dumping mortgage-backed securities, spiking spreads. Well, we see that the spreads are getting better, not worse. So that's not working. If buyers can't get loans, values fall regardless of inventory. Okay. And then 4, they have inventory must explode, 4 to 5 million active listings. Well, we see in Logan's article that we're at 800,000 active listings. Okay, right now, the U.S. floats around 900,000 to 1.1 million active listings. A 50% crash requires 2008 times 2 to 3 levels of inventory. That means a foreclosure surge. Now, if you read an article, there's our articles out there saying foreclosures are surging. But guess what? That is foreclosures compared to the COVID market. Okay. Short sales return. Okay. Investors dump properties. Okay. Now, there's been talk about that too. But if an investor, I was an investor for 32 years. And guess what? Some of those properties I've owned for quite some time. Even sitting vacant, I was fine with if it was vacant or the tenant wasn't paying rent. So just because a property is sitting vacant or an investor is not collecting rent, don't get me wrong, that's not a lot of fun, but that doesn't mean I have to put that home on the market and sell it right away. Okay. iBuyers and institutional owners fire sale assets. Okay. Institutional investors. I know there's a lot of talk about that, and you get a lot on some of these chats, and they talk about we should put laws in place against institutional ownership or buy to build to rent, and there's some truth to that. Okay, but you got to be very careful. I was in a chat a live stream a few days ago, and they said that investors shouldn't be able to own The most that an investor should be able to own would be 3 properties as an investment property. Okay. Um, you got to be really careful. For every gimme, there's a gotcha. And, um, so, there's going to be different sides of the fence on that, as far as feelings and things like that go. But I really think you got to be careful, um, you know, about, you know, and then here's the other thing too. Everybody thinks it's some big bonanza like this. It's this giant windfall owning rental property. Honestly, I think it's a little overrated. Okay. Um, it's not as lucrative as people make it out to be. Okay. And here's the other thing too. There's so many regulations associated with owning investment um, rental property. It's a ton of regulations. And it's just like when somebody says, well, investors are buying up all the single family homes. I can tell you this, they're not buying pre 1978 homes because guess what? That is loaded. Anything built before 1978, if they go to paint, if they're some giant firm, they're going to get sued unless they follow all the regulations involving RRP with lead-based paint. So those investors, if I was an institutional investor, okay, knowing what I know now, I would not buy an investment property built before 1978 because there's too much of a headache with lead-based paint, okay? And those rules came in place at around 2010. But if I'm a giant Wall Street firm, I am not touching anything built before 1978. Most investors don't even know the regulations associated with uh, RRP. Let me look that up here real quick. I'm gonna Google that real quick. Hang on just a second, just to show you what I'm talking about here. And let's okay, let's see what we have here in the chat. Okay. Clark says, yeah, I feel if the job market collapse along with other small factors that are personal to the individual seller. Yep. MH08 says, company I I work at has been shaking the bushes trying to get people to quit before laying us off. Yep, I believe that. Um, Clark says, that is what we are seeing in some parts of Metro Atlanta, institutional investors liquidating their properties. It's not the mom and pop investors. Okay, Clark, are they buying pre 1978 homes in Atlanta? Those institutional investors? Okay. In the cab business, the philosophy was you can make money on one cab and you can make money on two cabs. You can make money with 10 cabs, but in between, forget about it. Okay. Yeah. Um, yeah, I always figured that yeah, all right. And then most of the institutional investors are now buying new construction properties. That way they can get better rent. And I think they want to avoid this here. And I'm going to share this on the screen too. Okay, this is the uh, lead renovation, repair, and painting program. Okay, any renovation, repair, or painting project in a pre 1978 home can easily create dangerous lead dust. EPA requires that RRP projects that disturb lead-based paint in homes, childcare facilities, and preschools built before 1978 be performed by lead-safe certified contractors. Generally, EPA's lead RRP rule does not apply to homeowners doing RRP CP projects in their own homes. However, it does apply if you rent all or part of your home, operate a child care center in a home, or if you buy, renovate, and sell for profit, a house flipper. Technically, these house flippers have to follow these lead safe guidelines. Okay, um, but a lot of flippers don't, but they are supposed to. Okay, so that's why I don't think, me personally, I don't think these institutional investors, because if somebody caught wind, if Invitation Homes was buying up these pre 78 homes, trust me, they would sue the daylights out of them. Okay, you know, and rightfully so, because this was done to protect folks, because a lot of folks, um, to we're being contaminated with lead. In fact, we can talk about lead, but I guarantee you, those big institutional investors, they don't want to touch a pre 1978 home because of this. But here's the thing: it applies to mom and pop. It doesn't say institutional investors; it applies to everybody. But this came out in about 2010. And I guarantee you that's why these institutional investors are not touching anything built pre 1978. So that's my opinion on that. Let's see. Clark says most of the institutional are buying new construction property. That way they can get a better rent. Okay. You'd be surprised at the rents. I had a couple of Section 8 properties, and Section 8 is for low income folks, that the government subsidizes the rent. I had a couple Section 8 properties, and I got fantastic rent out of those. And I had some really good tenants. The uh, government, what they would do with Section 8 is they come out once a year to make sure the property was safe, sound, and secure. So you had an inspection once a year. And if you had an older property, they would go in and they're trying to protect the tenant, and you're getting a good rent. And uh, so there was a headache with the inspections and everything, but at the end of the day, it was just trying to protect the tenant and that sort of thing. And so for every gimme, there's a gotcha. But that was Section 8 was very lucrative in terms of, you know, um, the purchase price of the home was very low, but you still got market rents. Probably got above market rents. Okay. Clark says hit the like button. So this is why I think institutional investors, they're staying 10 miles away from this, because if a lot of these, they have a lot of tenant advocacy groups nowadays, that if you don't follow all the rules, these tenants can go get free representation, and trust me, they're gonna come after you. So if you're a landlord, so word to the wise. All right, but that's why I don't think that you're going to have I don't think the all of the institutional investors out there are buying up a bunch of pre 1978 homes, but I think they are buying there's build to rent communities. Now we have one local builder that won't allow investors into their communities to purchase. And then we have another builder who's a volume builder. Investors can buy those homes. So um, anyway, that's neither here nor there. So um, we'll go back to the active, um, what must happen in order for a 50% crash. Uh, it's been such a long time since I've seen a short sale. What exactly is a short sale? And that's where, see, right now, the folks that have a home, if they've had the home for any length of time, they have equity. Okay. A short sale, and back in 2008, we had a ton of short sales. And that's where the person uh, back in 2008, before the crash, the great financial crisis, they would have 100% financing. They'd have an 80-15-5 or an 80-20, and they would get 100% financing. Well, then what would happen is they would tell, and they would get an adjustable rate mortgage, and they would say, "Oh, don't worry, you can just refinance in a few years." Well, what happened? The price of the home went down. Okay, and now they were underwater and they couldn't refinance. And then these folks that got into adjustable rate mortgages, the rate adjusted and now they were upside down and their uh, payment would go up. Well, now they're upside down, they can't refinance, and then there were job losses. And then what happens? Well, now there were people doing short sales, which means you would go to the bank and say, "Hey, bank, uh, the house, I'm just going to make up a number, $200,000, and I owe 200,000, and now the house is only, the property's only worth 150." So you'd have to have the bank sign off saying, "Hey, they're willing to uh, sell it and take a loss." Well, that on a short sale, if you ever dealt with a short sale, they are painful because it takes a lot of time. But back in 2008, the great financial crisis, there was a ton of short sales. It has been years. I'm trying to think. Maybe I've seen one or two short sales in the last 10 years. That's it. Um, Clark, what about you? If you're still in the chat, have you seen any short sales in your market? Now they'll come around. They'll come around over time. Um, but right now, short sales. Um, Builders panic and offer deep discounts. Okay. Um, let's talk about. I'm going to talk about. Let's talk about inventory, um, homes for sale. I'm going to show this here. Okay. Show this tab here. Okay. This is going back. This is homes for sale by construction type. Red is existing, and green is new construction. Okay. And this is going back all the way back to when we adopted Paragon. Okay. But look at 2008, 2009. We had in our market, this is the Omaha area region, we had over 4,000 homes for sale. Okay. And then look at new construction. In 2007, you had 1,700 um, new construction properties. And then look what happens in 2010. And we had a couple builders go out of business. A few builders, unfortunately, took their own life. They during that time in our market, there were a couple builders that um, took their own life during that time because of you know because of the market. But you can see that back in 2007, new construction peaked, and then after 2010, look at the inventory with new construction. It's remained relatively constant. Okay, then look what happens in the COVID market. Look at new construction go down. Okay, and there was a time where we had more new construction than we did have existing. Okay, but look at this is a 6 month rolling average. I just wanted to kind of smooth out these lines a little bit. I could do a 12-month rolling average and kind of smooth it out even more. Okay. But look at the this is 2018, 2019. New construction, we had 732 homes on the market versus 1,300 for previously owned. And now we're returning. This was the COVID market. This was the great financial crisis, and this is all inventory. But now we're returning to a more normal market. So uh, hopefully that. Let's see. Clark says hit the like button. I appreciate that. Hit that like button. All right. And then we'll go back to uh, the a material decline in population growth or household formation. Demand collapse requires fewer new households. Okay. Examples. Okay. Immigration plunge. Well, we're seeing that with the deportations, and we're not seeing folks cross the border as much. Negative job migration into major metros. Okay. Major demographic slowdown. People are getting married later. Okay. Multi-generation combining due to affordability crisis, and we're seeing some of that too. So you're seeing more folks living in multi-generationally, where they buy one home and multi-generations are living in it. If household formation turns negative, it's a big blow to demand. Okay, a recession worse than 2008, you need a deep, prolonged recession, not just a soft landing. Okay, think multi-year GDP contraction, gross domestic product, corporate bond stress, commercial real estate failures feeding into financial markets, states and local government cutting jobs. A normal recession doesn't cut national home prices by 10%, let alone 50%. And then they talk about a structural shock, a black swan event. This is the wild card that accelerates the collapse. A major geopolitical conflict that spikes energy prices. I mean, some of this stuff is possible. Okay, um, a global credit event similar to the eurozone crisis, dollar instability, or sovereign debt panic, pandemic style economic shutdown without stimulus. Okay, catastrophic climate event hitting multiple regions. I guess if like an asteroid hit the Earth, that would be something along those lines. A black swan won't cause the crash by itself, but it would help push a fragile housing market over the edge. Okay, no federal rescue. A 50% crash only happens if Washington does nothing. Washington's pretty good at doing nothing, but you know, um, they didn't let the crash. They stepped in last time. Remember with the too big to fail, all that sort of thing. To get there, no mass forbearance, no eviction moratorium, no quantitative easing, no emergency rate cuts. I see the government. The government doesn't want a 50% crash either. Okay. No liquidity. They'll just print money, of course. Okay. Which they're good at doing that. Okay. And that's part of the reason what we had uh, in 2020 with the COVID market. They reduced interest rates so low and they kept them so low. And that's what caused some of this issue that we're dealing with now. A 50% drop requires zero intervention. Um, I see the federal government stepping in. I just, whether you feel good about that or not, there's going to be some folks that says, "Hey, let it go." But I think that would probably be more problems, not stepping in. Okay. Um, in 2020, prices didn't crash because the government stepped in instantly. A 50% drop requires zero intervention. Bottom line, a 50% national home price crash is mathematically possible, but it requires a deep recession, massive unemployment, high interest rates, credit freeze, inventory tripling or quadrupling, investor liquidation, banking problems. Now we have all of these things, but not in a massive scale. Okay. I mean, we have unemployment, but it's not massive when they talk about 12% or whatnot. You know, we have high interest rates, but it's not 10% interest rates. So, um, and you got to understand that these folks that produce these videos and write these articles, that's how they pay their rent, is they produce this content and people feed off of it because people are upset because like, well, yeah, I can't afford a house. It's somebody's fault. and then they feed off of this stuff. Um, it's to create, you know, and I get it. I mean, it gets clicks and views, but it doesn't mean it's going to be true. And nowadays, all you need is a a webcam and a microphone, and now all of a sudden you can be a housing analyst. Okay, um, so and then if something picks up steam and gets 175,000 views, well then guess what? News companies, like Newsweek here. Newsweek is uh, seems like growing up, it seemed like a legitimate news source. And then people read price correction worse than 2008. One of my clients texted me this article, and I'm like, what are you talking about? It's not going to crash. And then I heard who was the analyst, and I'm like, oh, for Pete's sakes, are you kidding me? But there's people that just feed off of this, and they eat it up, and they think it's gospel because uh, you know that's the way they feel. And now here's the deal. They're going to look at me and say, well, you're a real estate agent. Of course you're going to be rosy, and you're not going to you want a sale, so of course you're biased. Okay. uh, I mean, you always got, I look at, I try to look at both sides. I try to read articles even I don't agree with, just to read them, and sometimes just to get their perspective. And just because something, people will have that way about the National Association of Realtors. When the National Association of Realtors produces an article, if it fits their narrative, they'll use something out of it. Like the National Association came out and said, hey, the average age is, the median age of the first time home buyer is 40 years old. Everybody picked up on that because it fit. But the minute they said sales will be up next year, oh no, that's just the National Association. They're wrong. They're just trying to pump up sunshine and all that sort of thing. So I know there are people, you know Clark. Yep, you have to look at both sides. Yep, and you got to look at your own. You got to look at your own beliefs, because you have confirmational bias. Because I am a real estate agent, so there's uh, confirmation bias in there. But sometimes I don't know if they look at things critically, and I get it. They're getting a ton of views, and they're making a lot of money. Um, so I get it, but a lot of people just follow hook, line, and sinker like it's just gospel. So I just, but this kind of goes. What I liked about doing this with AI, people are going to say, well, hey, this is AI. How do you know that's accurate? And that's true. Oh, let's ask. MOH08 wanted me to ask, what day is it? Let's ask. Oh. What day is it today? We'll find out. MH08 wanted me to ask this, so let's see what it says. Today is December 2nd, 2025. Okay, so it's like, well, I hope it says something. So it is December 2nd. So it's hard to believe it's already December. So it's anyway, I wanted to share that with you. Wanted to, let's see here. The numbers are a little bit early yet. Let's see. The numbers are a little bit early out yet, so I can't, looking at closed. This is the Omaha area region. This is monthly. Um, let's see. Wow, last month it said it couldn't tell me what day it was. For some reason, I don't remember. I have the paid version of ChatGPT. I don't know if that makes a difference or not. And then I asked ChatGPT. Sometimes you ask ChatGPT a couple of things. You keep, um, I don't. You can set parameters. Like I don't want you to guess at something, or I don't know what Christina Smallhorn gave me a tip on it. And as far as setting parameters, like when I do my ChatGPT, it'll say, um, based off, source data, not reliable sources or something like that. But okay. 107 days, 12 hours, 50 minutes, and 32 seconds until spring. Okay. Well, you know what? The spring market really kicks off in January. I mean, the market, um, I wanted to show that, guys. I wanted to point that out here. Pending sales, the last, I want to go line, um, the last 3 years. And I wanted to show pending sales. Okay. And I wanted to kind of show you how how the market follows patterns. Okay, this is the last 3 years. Okay, and this is pending sales. Now it's a little early in the month to get closed sales for November because some agents may not have turned in their paperwork yet. Okay, but you can see that sales tank. The red is existing homes and green is new construction. But you can see that in December, pending sales dry up because number one, there's an extra holiday in there. Okay. And then a lot of folks take their home off the market. Okay. But December's pending sales is January's closed sales. So you can see that in the existing market, you can see this pattern. Okay. And sure enough, this year, um, we go from October to November. Now, this is a little early for closed sales, so I'm pulling it a little early because not all the numbers are in yet. But this is what I use for my market data, uh, uh, my monthly updates. But uh, we'll go out 5 years, okay? And this is closed sales by construction type, okay? Look at in July of 2020, we had 1,500 closed sales. Okay. And in June, we had 1,500. Look at how, as these interest rates increased, look what happened to the total number of sales for existing. That these peaks are not as high as they were back in 2021 and 2020 because they had to kill demand. Okay. Look at how new construction remained relatively uh, constant. Okay, that's because the new construction market can regulate itself. They're not going to put a whole bunch of new construction out there because if a home is sitting vacant and that builder is sitting on a home that's built and vacant, that is costing that builder a ton of money. Okay. Let's see. Son of Joxer says market corrections are not crashes, but also less sexy. 100%, absolutely. A correction, and the market's going to correct. We're having that correction process going on right as we speak. What we're doing, getting back to pre-pandemic, is a correction. So the market is correcting itself. This is killing off demand, and that's a correction. Okay, um, it's closed sales. Okay, now let's look at price. Okay, but see, we're not selling as many homes. Okay, and then um, you know it's a sales crash. Okay, if we do this by 12-month rolling average, and uh, we'll go 10 years, you can see that this is the 12-month rolling average. And you can see that when we increased interest rates, what happened to the number of sales? That went down. But see, here's what happens with new construction. New construction can regulate itself. They're not going to build. They'll lay people off. They won't necessarily, they don't want happening what happened uh, back here. Remember when they had 1,700 new construction homes? This was back then. They had 1,900 homes on the market. They don't want to go back to that. Okay. So builders learn their lesson. And let's go back to 10 years. But you can see that this is the existing market in red. Okay. And then sales went down. We're not even in a 12-month rolling average. We're used to getting 12,000. This is Omaha area region, 12,000 sales a year. We're at 10,000 sales a year. So that's why I would say if rates go down, we should see it correcting and going back up to a more normal level. But it's going to take time before that happens. Now, this was when rates were at 4%, 3%, things like that. Well, if we lower rates too much, you don't want to, we want prices to not appreciate 10 to 15% a year. Okay, let's look at closed prices. Okay, and let's go line, let's go 5 years, and then we'll go month to month, monthly. We want prices to stabilize and level off. We don't want prices to keep go. If you're a homeowner, that's great. Your house goes up in value, but we need prices to level off and stabilize so people can go out, so we can increase affordability. Okay. Anyway, that's neither here nor there. But any other questions for me in the chat? Anything else? We've come to an hour, and appreciate you guys hanging out. Hope everybody had a great Thanksgiving. And I always have fun with these numbers. I think it's a lot of fun to look at these numbers and look at these. It's, hopefully you get some value out of it. And then if you want, check out my market prediction video. I'll share this. Check out my market prediction video for next year. I did a market prediction video, and then I reacted to last year's predictions. So that's always all right. MH0862, the official end of my weekend. All right. But hey, everybody, I tell you what, it's always fun. I appreciate everybody stopping by. Hey, let's look. We got, let's see here. Let's Clark, make sure you stop by, and let's give Clark a shout out here. Share this. Always appreciate Clark. My friend Devon Clark out of Atlanta, Georgia. He does a show every Sunday, 7 p.m. Eastern time. Check out his program. It's great and a lot of fun. I enjoy it. Clark, I enjoy your I enjoy your show. So give Clark a shout out, and 1,100 subs. All right, so that's great. And watch his live streams and stuff like that. And appreciate the kind words. All right, but give Clark a sub, and appreciate. Oh, you're welcome, Clark. You betcha. You betcha. Absolutely. I enjoy having you on the pro. We got to do a live stream together eventually. We got to do that. So maybe we'll do that. I'll reach out to you, but we'll do that. So anyway, hey, everybody, I appreciate it. And you guys have a great evening. Again, thanks for stopping by. I'm glad the sound was okay. And you guys make it a great day. Bye-bye.